Hi, I'm Louis. Which telco counter in Malaysia stock market is most worthy to be invested? Profit and dividend distribution. Between financial year 2012 to 2021, the profit after tax of Axiata, Maxis, Digi and Telecom have been trending downwards, while the profit after tax of Time.com has been slowly increasing. Likewise, it is shown in this figure that between financial year 2012 to 2021, only Time.com was showing increasing earning per share, while the earning per share of the other four telco counters was decreasing over time. In the last few years, the dividend yield of the five telco counters mostly ranged between 2 to 4%. By comparing the average dividend yield of the telco counters, it is shown that on average, Maxis and Digi had the highest dividend yield at around 4%, while the other three counters' dividend yield mostly ranged between 2.5 to 3%. Dividend payout ratio indicates the proportion of net profit being distributed to shareholders in the form of dividends. In the last few years, the ratio of the five telco counters mostly ranged between 40 to 100%. By comparing the average dividend payout ratio of the telco counters, it is shown that on average, Maxis and Digi had the highest dividend payout ratio at around 100%. Management efficiency. Between financial year 2012 to 2021, most of the telco counters' net profit margin was decreasing over time. By comparing the average net profit margin of the telco counters, it is shown that on average, Time.com has the highest net profit margin at around 30%. Figure shows that during this period, Digi had the highest return on equity. This is due to the fact that Digi tends to pay out almost 100% of its profits to shareholders in the form of dividends. Hence, its equity level is much lower than the others, which results in very high return on equity. Zooming in the scale to view the trends, it is shown that most of the telco companies' return on equity have been trending downwards. Only Time.com was showing increasing return on equity. By comparing the average return on equity of the telco counters, it is shown that on average, Digi has the highest return on equity at around 280%, while the return on equity of the other telco counters range from 10 to 30%. Figure shows that in the last few years, Digi had the highest return on assets, while the other counters' return on assets range between 1 to 10%. By comparing the average return on assets of the telco counters, it is shown that on average, Digi still had the highest return on assets at around 29%, while the return on assets of the other telco counters range between 2 to 9%. Stock valuation. Between financial year 2012 to 2021, it is shown that Axiata has a much higher total assets value compared to the others. By zooming in the scale, it is shown that the total assets of all telco counters has been increasing over time. This is due to the telco companies are making profit every year. Hence, assets get accumulated as the years go by. By comparing the average total assets of the telco counters, it is shown that on average, Axiata has the highest asset value at around RM 60 billion, while the other telco counters have lower assets value. This is due to Axiata is a multinational company with subsidiaries and signal tower assets in a few other countries, while the other telco companies are mainly based in Malaysia. Net tangible assets is equal to total assets minus the total liabilities. It is shown in the figure that the net tangible assets of the telco companies are mostly constant over the years. This indicates that while the total assets of the companies are increasing over time, the company's debt level have also been rising in a similar pace. By comparing the average net tangible assets of the telco counters, it is shown that, on average, Axiata is also having the highest net assets level. Between financial year 2012 to 2021, it is shown that the share price of Axiata, Maxis, Digi and Telecom have all been trending downwards. On the other hand, the share price of Time.com has been rising over time, showing that shareholders are raising their valuation on this stock. Price-to-book ratio is calculated by dividing share price with net tangible assets per share. Lower price-to-book ratio, especially lower than 1, is preferable. This shows that the share price is undervalued and has room for upward movement and worthy to be invested. Between financial year 2012 to 2021, it is shown that DG has a much higher price-to-book ratio compared to the other telco counters. This is due to DG having a much lower net tangible assets level than others. By zooming in the scale, it is shown that the price-to-book ratio of Axiata, Maxis, Digi and Telecom is either unchanging or trending downwards. On the contrary, Time.com's price-to-book ratio was trending upwards, indicating that investors are increasingly favorable on this counter and willing to pay higher price to invest in it. P/E ratio is calculated by dividing share price with earning per share, which shows the ratio between the share price and the earnings of the company. If the ratio is very high, it shows that the share price is at a high point, which is not worthy to be invested. Between financial year 2012 to 2021, the P/E ratio of these 5 telco counters mostly range between 20 to 30 times, which shows that the current share prices are relatively expensive to invest in. The market cap is calculated by multiplying share price with the number of shares. Hence, higher share price will contribute to increasing market cap and overall valuation of the company. It is shown that during this period, the market cap of Axiata, Maxis and Digi have been decreasing over time, while the market cap of Telecom was mostly unchanged. Only Time.com's market cap has been trending upwards, indicating that investors have a positive outlook on this counter and willing to pay more to invest in it, resulting in gradually increasing market cap. By considering the number of shareholders holding the stock, it is shown that Telecom's number of investors have seen a significant uptick since 2017. However, there has been no significant growth trending on the number of investors for the other 4 telco counters. In financial year 2021, Maxis and Telecom are the most popular counters, having the highest number of investors. Financial management and stability. Between financial year 2012 to 2021, it is shown that all 5 telco counters have been consistently investing in their infrastructure. This capital expenditure spending have been used to establish and upgrade various software and hardware equipment in order to improve connectivity and services for their customers. By comparing the average capital expenditure of the telco counters, it is shown that on average, Axiata is having the highest capital expenditure spending level, which is up to Rm 5,500 million per year. Equity to liability ratio is calculated by dividing total equity with total liability. If the ratio is above 1, it is shown that the assets level of the company is higher than its debt level, indicating that the company's finances are stable. Between financial year 2012 to 2021, it is shown that Maxis, Telecom and Digi have a ratio that is lower than 1, indicating that their long-term debts are relatively high. On the other hand, the ratio of Time.com and Axiata was above 1, showing that their debt is relatively low and their finances stable. Current ratio is calculated by dividing current asset with current liability. If the ratio is above 1, it is shown that the short-term assets level of the company is higher than its short-term debt level, indicating that the company's finances are stable. Between financial year 2012 to 2021, it is shown that the current ratio of Time.com and Telecom was above or close to 1, indicating that the company's short-term debt level was low and they are having enough funds to pay off their short-term debts. However, Axiata, Maxis and Digi's current ratio is lower than 1, indicating that their short-term debt level is high. Although the debt level of these 3 counters is relatively high, note that their customers are mostly bound to mobile network services contracts, and they pay monthly for their services provided. This leads to a stable source of cash flow for these companies, which enables them to maintain stable and healthy finances. Between financial year 2012 to 2021, it is shown that all 5 telco counters have a significant amount of cash flow reserve, indicating that this company's finance is on a stable footing. By comparing the average cash flow of the telco counters, it is shown that on average, Axiata has the highest cash flow level, while the quantity of cash flow for Digi is the lowest. By considering the company's cash flow per share, it is shown that Time.com's cash flow per share has been increasing gradually, while the cash flow per share for the other counters are not showing obvious upward trending. By comparing the average cash flow per share of the telco counters, it is shown that on average, Telecom has the highest cash flow per share, while Digi has the lowest amount. This may be due to the fact that Digi has a dividend policy of distributing almost 100% of its total profits to investors in the form of dividends. Hence, it tends to have a lower cash reserve amount. In recent years, there has been intense competition between telco services providers. This results in gradually decreasing profit level for Maxis, Axiata, Digi, and Telecom. The telco counter with the best performance is Time.com, with uptrending profits as well as share price. Time.com rely on its fiber optic network assets to provide connectivity services to its customers, which is characteristically different from other telco companies. It is also serving a different segment of customers. Hence, it is exposed to lower level of competition. As such, it is able to maintain a net profit margin of around 30%, as well as achieving increasing profit level year on year. However, noted that Time.com's share price has also been increasing over time. Its current PE ratio is around 20 times, indicating that its share price is relatively high. It would be preferable to buy on a price dip. By considering the dividend yield, it is shown that currently Maxis and Digi have the highest average dividend yield at around 4%, while the other 3 telco counters average between 2.5 to 3%. All 5 telco counters have PE ratio ranging from 20 to 30 times, which indicates relatively expensive share price. Interested investors are recommended to watch closely and try to enter the market at lower share price, which would make it a better investment with improved dividend yield and capital appreciation. Based on the info presented in this report, have you made up your mind? Which telco counter do you think is most worthy to be invested in? That's all for today. Feel free to share your thoughts in the comment section. See you next time. Bye. The content above is for sharing and reference purpose only. It is not an investment recommendation. Investors are encouraged to carry out further research and analysis as well as follow up latest update information before making any investment decisions.